Major averages. Joining us now is Peter Cecchini from Axonic. Peter, today aside, I mean, how much of this has to do with consumer confidence? How much of this do you think investors should maybe fade, sell?
Yeah, hi, John. It's a great question. We would all, love to believe that the issues with regional banks are well in the rearview mirror, and certainly the Treasury and the Fed acted decisively to restore confidence and prevent a broader contagion. But I think the takeaway from what happened there is that banks will be less profitable lenders and less willing to lend. And consumer confidence, which has already been challenged, and demand for loans, which has already been quite moderate, and in fact contracting based on the Fed's own surveys, I think will suffer even more in the sort of wake of what we just experienced over the past couple of weeks. Yeah,
that's what I wonder. And this Conference Board Consumer Confidence Index being up so much versus expectations, it seems like consumers were saying they're especially excited about what happens 6 months plus from now. But isn't that what the Fed was saying is really hard to tell, where they think we're going to feel the impact of this credit tightening? And when some people have been telling us, well, that's probably when we're going to get a recession right before Q4.
Right. And it's what's interesting about the Conference Board survey versus Michigan is they're quite divergent. The Michigan survey, even on an expectations basis as well as current sentiment, has been quite a bit less bullish relative to consumer expectations in Conference Board. And frankly, both within the context of history have not been spectacularly strong. So, I've had some difficulty sort of reading much into either one relative to positive consumer expectations. And I've actually sort of taken the other side of that, saying, look, consumer expectations have actually not been all that great in the context of history.
So what are the best ways in this market to take the other side? Regional banks maybe look expensive, but you might be afraid to buy them because you're thinking, well, maybe other investors out there know something that I don't. Do you buy them here, or do you have to be extra selective because there's going to be consolidation and maybe some of those smaller banks will have trouble?
Yeah, I mean, one of the things that these sorts of dislocations do is it provides opportunities for those who are willing to do their work and do their research. The dispersion of performance is likely to be quite great among regional banks. We're about to come out with a piece that actually identifies, banks that we think are at the greatest risk based on their lack of loan loss provisions and reserves relative to deposits. And in fact, the four banks that failed took very low provisions. So there will certainly be winners and losers. The banks, regional banks as a group, look inexpensive, but there are clearly going to be opportunities to buy regional banks inexpensively at this point.
Well, let me close by asking you about mega cap tech. Apple and Microsoft both comfortably above $2 trillion in market cap. Apple at 2.5, and that's been the flight to safety, right? That's been propping up a lot of major indices. Should investors run from those, or do they remain safe?
Well, we know this is your wheelhouse, John. It's interesting to realize that they're more than 15% of the S&P 500, and one of the reasons we can't look at the VIX anymore as a real gauge of broader market volatility, as Mike just pointed out, is because of that. It certainly, to me, makes the market more fragile. That is to say, when you have so few names carrying an index and keeping volatility low, it doesn't take much to wobble the index, in my view.
Yeah, you don't want Microsoft to tear its ACL in this, or you might have trouble winning a championship. Peter Cecchini from Axonic, thank you.
Thank you.